This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Hello, you sexy sat stackers, and welcome to the latest episode of the Bitcoin Bulletin Podcast. I am coming to you from an undisclosed location high in the mountains of the western United States. And as I mentioned in the last podcast, I unfortunately had to leave Florida literally the day before the Bitcoin 2023 conference kicked off in Miami. So I hope all of you that headed out to Miami to enjoy our wonderful state, hopefully you tolerated that hot, humid weather. As I mentioned last week, May is an odd choice to have a conference in Miami because, as many people have said, Miami is very hot. That's why they call the basketball team the Heat. And it's a heck of a lot nicer in the winter. Certainly if they had held the conference in November through even just a month ago, the weather would have been just flat out gorgeous. But I guess it was still probably a nice break for a lot of you to come out and enjoy the tropical weather. The sun, a little bit of humidity, and just a great time, and I'm really bummed that I missed it. But I digress. Today is Wednesday, May 24th, 2023, and that means it is DCA Wednesday. Are you ready to grow that stack? Before we do, a real quick look at the vital statistics. At the time of this recording, we are sitting at a blockchain height of 791,236, and Bitcoin is clocking in at a US dollar price of $26,375 or 3,791 sats per dollar. That is about, we're going to get about 140 sats more per dollar than we got just last week because Bitcoin is about $1,000 cheaper than we made our last stack. And along those lines, we are currently 48,764 blocks away from the next Bitcoin halving. As you know, Bitcoin's miner reward gets cut in half every 210,000 blocks, which works out to about every 4 years. And the next halving will occur at block 840,000. And currently, if blocks keep coming in at a consistent rate, that's looking like that's going to occur now on April 21st of 2024. That's gotten 1 day sooner. The last 3 podcasts in a row, it was estimating that was going to be April 22nd. But we're really not going to know when that halving occurs until it occurs, really, because, let's say it's 11 o'clock on the 21st, and then all of a sudden we get one of those blocks that takes an hour to mine. That could make the difference between the 21st and the 22nd. But I digress. Back to the vital statistics. Bitcoin's current price gives it a market capitalization of $511.2 billion, down about $19 billion from last week, as the price has trended downward slightly, like I mentioned. Since our last stack, we're down about $1,000 from where we were on the 17th of May when we did our last DCA Wednesday episode. But despite the fact that the price of Bitcoin is down in US dollar terms, the price of gold is down even further because it will currently cost you 13.3 ounces of gold to purchase just one Bitcoin. And that is a heck of a lot of shiny yellow rocks. 13.31 ounce gold coins to purchase just one Bitcoin. As you know, gold had been on a little bit of a tear when its traditional store value narrative was being driven by the banking crisis, in exactly the same way as the Bitcoin price pumped as a result of the banking crisis as well. For those of you who value your wealth in pizza, one Bitcoin will currently purchase you 1,475 Papa John's pizzas. And if you were paying attention, just a couple of days ago was the 13th anniversary of Bitcoin Pizza Day. That day on May 22nd of 2010, when Laszlo purchased 2 large Papa John's pizzas at the whopping price of 10,000 Bitcoins, which was worth about $30 at the time. Wow, we have come a long way in the last 13 years when Laszlo made that purchase, because right now you could enjoy one large pepperoni pizza from Papa John's for more than 4 years, for pushing 5 years, for just 1 Bitcoin. A lot has been said about both Laszlo and about the person that Laszlo sent those 10,000 Bitcoin to, because he didn't pay Papa John's in Bitcoin. He put a request out over the forum and made an arrangement with somebody to trade 10,000 Bitcoin to that individual so that he could call in a pizza order for Laszlo at his house I believe he's in the Tampa, Florida area. I think he lives in Tampa now, but I think at the time it was Jacksonville, somewhere in Florida, 13 years ago, 13 years and 2 days ago today. All right. The mempool it's looking a little, it's a catch-22 because it's looking a little more full than it was last week, but fees are coming down. Currently, there are 92 blocks of the transactions pending in the mempool that I'm looking at. Last week, there were 82 blocks pending. However, last week, the fee estimators were saying that it was going to take a minimum fee of 79 sats per VByte to guarantee that your transaction was included in the next block. And that is down dramatically to 54 sats per byte. And it's saying that it'll only take 94 sats per VByte to guarantee your transaction goes through in a day. And 1 sat per VByte transactions will still clear in a week. Obviously, a lot of that is still that ordinal, those BRC20 tokens that were made possible by the Taproot activation. And they're very, very small transactions, so a lot more of them can fit in a block as long as they don't fill up that header space or the witness space of the Bitcoin block. And as a result, the 24-hour transaction volume, that metric I like to follow, is much more in line with where it normally should be. Last week, it was screaming at 7.06 transactions per second. And right now, we're looking at an average of 4.61 transactions per second. Still way above the 4 transactions per second that on-chain was theoretically meant to handle before the whole ordinals and inscriptions thing came along. But since those transactions are so small, a lot more of them are fitting into each block. However, they are low-fee, low-priority transactions, so your on-chain transactions are getting cheaper and cheaper as that fad hopefully dies and goes away. Since last week, the Bitcoin mining difficulty was adjusted significantly upwards. There was a 3.2% difficulty increase in the computational difficulty that it takes to mine the next block. As you know, Bitcoin mining difficulty is adjusted every 2016 blocks, which is theoretically every 2 weeks or so, with the goal in mind of keeping an average block time of 10 minutes between blocks. And currently, we're looking at the next adjustment being a very small increase. We're about 1,052 blocks. We are exactly 1,052 blocks away from the next mining difficulty adjustment. So we're halfway between adjustments. It's looking like that's going to happen on May 31st, so a little over 7 days from now. Currently, that's expected to be an increase of anywhere between 0.2% and 1.45% because blocks are averaging 10 minutes and 1 second. So just a little bit slower than expected at the moment. But again, these calculations are they're really just a forecast based on either the trend within this difficulty epoch or within the last 2016 blocks, depending on who's doing that calculation for you. Currently, though, it's looking like we're pretty spot on. 10 minutes and 1 second is really close. In fact, we haven't seen it that close. The closest we've ever seen it to the 10-minute goal is 10 minutes and 4 seconds 3 weeks ago. Blocks have been coming in a little bit slower the last several weeks, the last month or so, and that's why we had a couple of difficulty. Blocks were coming in. Blocks had been coming in really fast, and that's why we had the difficulty continuously increasing. And then we had a few minor difficulty pullbacks. And now it looks like the hash rate has settled down a bit, and we're back into the difficulty increase trend solidly. So, it's another one of those things. If you zoom out, it's the hash rate securing the Bitcoin network has been up and to the right throughout Bitcoin's entire lifetime. There have been a few downtrends here and there, like when the China mining ban happened and 30% of the hash rate went temporarily offline. There was another big dip when they had those ice storms in Texas and all that quote unquote renewable green energy went offline and Texas was without power for like 2 weeks. And then in the following year, the most recent cold winter in Texas, the miners shut off voluntarily because they had engaged in grid load balancing agreements with ERCOT, with the power grid provider, to shut off voluntarily so that they could avoid those blackouts or brownouts this time around. And it worked. That's one of the successes of Bitcoin. One of the ways that Bitcoin is actually good for the planet, not bad for the planet. But that's not what we're here to discuss. What we are here to discuss is dollar cost averaging today. But real quick before we do that, thanks to those of you listening on your favorite podcasting 2.0 apps, such as Fountain and Breeze. There are a bunch of you. We don't currently have any boosts to read unless somebody sneaked one in right as I was setting up to record. But at the moment, when I hit record, nobody had sent a boost this week. But I know there are a bunch of you out there listening because I get the statistics and I see where you are, and sometimes you're streaming sats and boosting. So we do appreciate that. Thank you for helping support the podcast through value for value. It's really cool. 1,000 sats, 6,000 sats, 10,000 sats isn't a tremendous amount of money, but it's very rewarding. When you're sitting here by yourself talking into a microphone, I can't see all of you out there. I can visualize the people listening to the podcast in my mind because I look at the statistics and I see where you're at. But when the boosts come streaming in, or the sats come streaming in, or just the shout outs on Twitter or by email come rolling in, that's when it makes it all worth it. And I'm sure you've heard all your favorite podcasters say this, but it does feel good to know that what you're doing is appreciated. So thank you again to all those of you who are listening, whether you're listening via Podcasting 2.0 or whatever your favorite podcasting app is. Before we get to that stack, a real quick look at the news. Obviously, part of the big news is the price. Bitcoin is down a bit. But remember, as I've said during multiple podcasts, functionally, we're reliving 2019. If you believe in the 4-year cycle theory or Adam Meister's 210,000 block theory, which is basically the same thing, only, Bitcoin doesn't have every 4 years. It has every 210,000 blocks. So tomato, tomato. But if you believe in that theory, basically right now we're reliving 2019, and Bitcoin should be going basically laterally, side to side, if you zoom out a bit. In 2019, Bitcoin had a pretty good run a couple of times, but it dipped back down to its cycle low again right before the halving. And so with the halving being almost a year away still, we really shouldn't expect the bull run to kick off until we're either a lot closer to the halving, or usually it kicks off slightly after the halving. Generally, we don't set a new all-time high until about 6 months after the halving, and then the final blow-off top all-time high is usually a year to 18 months after the halving. So with that in mind, we shouldn't be talking new all-time highs until November-ish of 2024, and then in the spring of 2025 possibly, before we have whatever the next all-time high peak is going to be. Plan B tweeted out a poll on Twitter a few hours ago asking his followers what they thought about where we were in the cycle, and 54% of respondents voted that we were in the early bull market stages. 28% of them said that we were in the late bear market stages, and I was disappointed in the poll because we're kind of really in neither. We're in that accumulation phase that's a little bit different from traditional markets. Normally, the stock market's either going up or down throughout the history of the market. It's never really gone sideways for an extended period of time, maybe during the 1970s, which is another point. If we're reliving the 1970s, that might truly mean this time is different in some ways. But in general, I'm a firm believer in that 4-year cycle theory, that the halving dictates where Bitcoin's price action is. And that's just simple economics. And we're not talking Keynesian economics. We're talking, the basics, the supply and demand, the things that are rare are more valuable. And Bitcoin gets a little more rare every halving because the majority of the Bitcoin that's available for purchase on exchanges is being dumped there by miners, because mining is, the big commercial miners, it's a business, it's a for-profit deal. And most of them are not hoarding all of their Bitcoin. They have to sell at least some of it to pay for electricity and maintenance and rent, what have you. So just to pay their taxes, for example. So a lot of that Bitcoin that's available for sale is mined by huge commercial miners. And when the amount of Bitcoin those huge commercial miners are raking in every day is magically cut in half, well, you can see why that would have an effect on the price of Bitcoin. I mean, everybody, I think, is familiar with the concept of supply and demand. Another reason that Bitcoin's price is down is because of the FUD out there. And this is just general economic FUD. It's twofold. The banking crisis is still lingering out there. We are definitely screaming into a recession, whether or not we already are in one, depending on who is in charge of the definition, since definitions are subject to change now in our new paradigm. But according to the old tradition, the definition of a recession that stood for decades, we entered a recession a year ago. And that, of course, was defined by 2 consecutive quarters of negative GDP growth, which we had. As you recall, the administration said, oh, no, we're not in a recession because we've got this just a fantastic economy if you look at the employment numbers, which are kind of a joke because the employment numbers don't take into account numerous things. For example, they don't take into account people who are not looking for jobs. If they've been laid off and they've just given up, if there are no jobs available and they stop looking, they're not counted. If they're retired, they're not counted. And most importantly, if you got laid off from a big fintech company and you were making $180,000 a year, but you went and you managed to get a job as a greeter at Walmart, well, they count that as a 1-for-1. As far as the employment statistics go, we didn't have a decrease in employment. And if you had to get such a crappy job that you need to get a second job, so let's say you work at Walmart and then in the evenings you're a bartender just so you can help make ends meet because now all of a sudden you're earning $100,000 a year less than you were earning. You're still making dramatically less money. The economy is obviously in worse shape, but that shows a net increase in employment, which is it's a joke. It was Mark Twain, I believe, that said there are 3 types of lies, damn lies, and statistics. And government statistics are definitely in that category because pretty much any number that the government puts out is heavily massaged and manipulated to present the picture that they want to present. And the employment number is at least as manipulated as the inflation and economic and GDP numbers. Probably one of the most manipulated, simply because, like I said, they don't count jobs as equal jobs. They count them as by number of jobs. Of course, we're also running into that whole debt ceiling debacle, which is mildly infuriating because the media is very complicit in this whole thing. If you watch the news, if you hear Treasury Secretary Yellen, or if you see Biden on the news, they all say that the only choice is that we raise the debt ceiling or we default, right? So what this means, if you relate this to your personal life, let's say that you have a job making $100,000 a year, but you normally spend $120,000 a year because you max out your credit cards. But now your credit cards are maxed out. You've already spent $20,000 more than you make, but the only option for next year is either default on your credit card or get a new credit card so that you can use a new credit card to start making your old credit card payments so you can continue to spend even more. Next year, you want to spend $130,000 when you're still only making $100,000. It's silly. What I'm trying to get at is that there aren't just 2 choices, raise the debt ceiling or default. There's a very obvious third choice, and that is spend less. If it were a person and not a government, it would mean, hey, maybe you just don't go out to dinner one night a week, or maybe you don't upgrade your iPhone this week. And that's what the government is. Their government is broke. The government has maxed their credit cards. The government is going to spend more money than they take in and that their credit cards could possibly support next year. And they're throwing a tantrum because they want you to give them another credit card so they can buy a new iPhone. And it's just ridiculous. And of course, all the markets are tanking as a result of that. Stock markets are down, and Bitcoin kind of followed down as well to some extent. Although, like I said earlier, if you zoom out, this cycle looks a heck of a lot like the previous cycles. And there's a chart out there that Econometrics puts out on Twitter. It's a fantastic chart. It overlays the previous halving cycles. And there's a shaded area that's the mean and the average, or the range, and then the mean with another line in the middle. And ignore that. Just look at the 2 previous halving cycles and this halving cycle, and you can see a trend there. Obviously, the Bitcoin didn't increase percentage-wise as much as it did during the last run, and maybe that gets into that diminishing returns theory. But the shape, the days when Bitcoin's going up and the days when Bitcoin's going down line up fairly accurately. Obviously, there's a little bit of differences here and there because on a day-to-day basis, the minutia is different this year than it was 4 years ago. But in general, we're doing what Bitcoin should do. This is the accumulation phase. And it's fantastic if you're a stacker because we're going to get to buy Bitcoin for less. Well, we're going to spend the same amount of money, but we're going to get more Satoshis. So we're going to get more Bitcoin for the same amount of money, which is absolutely fantastic. especially if you're like me and you don't think that you have enough Bitcoin. Your stack isn't big enough. And if you aren't like me and you think you have enough Bitcoin, you may find yourself reassessing that, reevaluating the size of your stack when we do hit the next all-time high and you feel like, oh my God, now it's too late. Now I've missed out. So don't be that guy. Grow your stack, and you can do so along with us in just a few minutes. Also out there, as I mentioned previously, last weekend was the Bitcoin 2023 conference in Miami. I was not there. It was the only week in months that I haven't even been in Florida, which was kind of bizarre. But some of the cool things that happened were the politicians were out in full force. We had RFK Jr., of course, was probably the biggest headline speaker as far as the politicians go at Bitcoin 2023. And he gave a solid red meat speech. I mean, he nailed every single point. He said the reason he got interested in Bitcoin was he saw what happened during the Canadian trucker protest, the convoy when Canada shut down the bank accounts, basically froze the ability of the truckers to survive, seized their money, and Bitcoin. There was kind of a fumble on the Bitcoin donation because the people that did so were we hadn't really ever had to do this before, and it was a learning experience, even though there were some Bitcoin OGs that were involved in it. Lessons were learned, but needless to say, what it showed the world was that if you're doing something the government doesn't like, they can choke you out of fiat money, and they can't stop Bitcoin. They were, however, able to go after well-known public addresses because the Bitcoin wasn't transacted privately. But I digress. That's when RFK Jr. said he first saw the value of Bitcoin. He gave a really great speech about freedom of speech, about freedom to transact and why Bitcoin is important. And Bitcoin was as important as free speech to him. It was a solid speech. As I've mentioned before, I am not an RFK Jr. fan. He's done a lot of things in the past that I wholeheartedly disagree with. I would find myself having a really hard time voting for him for president, but he did give a fantastic speech. Also, Tulsi Gabbard, however you pronounce her last name, I'm sorry, gave a fantastic speech. She's running for president. She didn't hit all the points like RFK Jr. does. She gave a viewpoint that, definitely wasn't hostile to Bitcoin. She was, at the conference to support Bitcoin and speak to Bitcoiners, but it just, it wasn't as well researched, at least, as RFK's speech. And Vivek, who's running for the presidential nomination as a Republican, also gave a speech, and his was solidly less impressive. Basically, the only time he mentioned Bitcoin was when he said that he was accepting Bitcoin and asked you to whip out your phones and make a donation. Another really big deal that happened at the conference was Jack Mallers gave his speech and announced that Strike is moving their corporate headquarters from Chicago to El Salvador, and that is really cool. I think you're going to see a lot more of that in the not-too-distant future. I know other companies are at least establishing a presence in El Salvador, and that's because not only is Bitcoin legal tender in El Salvador, but they passed some really great laws recently that are very advantageous to businesses. If you relocate, for example, there's no income tax, sales tax, or property tax, I believe, on fintech businesses, basically. So Strike has every incentive in the world to move to El Salvador. Not to mention companies that are involved in the Bitcoin space, it's just better for them to be in a country that's not actively trying to squish Bitcoin adoption. So it was a great conference, and I'm sad I missed it, but I had other things to do, and next year, I guess, the Bitcoin conference, Bitcoin 2024, is going to be in Nashville, Tennessee. So maybe I'll get to go to that, and that will be cool because I'll get to go see Nashville. I don't think I've spent any time in Nashville, so it'd be neat to go see that community, go see the Bitcoin park that they've established in Nashville, and it'd be just a little different because, Florida's home for me, so getting to travel makes conferences a lot more exciting. Obviously, the best part is meeting you plebs, getting to network and connect with people that you only know through Twitter or through podcasts, et cetera, getting to meet face-to-face. But getting to travel away from home is one of the fun parts, too. So maybe I'll get to go to Bitcoin 2024 in Nashville and meet up with some of you, and that would be really cool. Also in the news, as you remember a week or so ago, I mentioned that Home Depot had missed their Q1, their first quarter revenue forecasts, and I had said that, or I posted on Twitter at least, that was a big deal because when the home improvement places, when the DIY places are going downhill, that's a bad sign because normally businesses like, auto parts stores and Home Depot benefit at the beginning stages of a recession because people are trying to save money. Instead of taking your car in and spending $300 to have a mechanic fix it, you go to Checker or AutoZone or whatever your parts store is, and you get that alternator for $80 and you put it in yourself. Same thing with Home Depot. Home Depot normally does really well in the recession, at least in the beginnings of the recession, because, instead of having a contractor come out and paying them $3,000 to do something to your kitchen or to replace your water heater, you just go to Home Depot and lug a new water heater in and put it in yourself, and you put your water heater in for, significantly cheaper. So usually these DIY businesses do very well at the beginning of a recession. So first, Home Depot missed their revenue earnings, and now yesterday, Lowe's revised its forecast downward. They're struggling as well, and that is a bad sign. That would indicate that we are not only heading to a recession, but we've been in one for a while. If we had used the traditional definition of 2 quarters of negative economic or negative GDP growth, then we'd already have been in a recession for a year, and that would explain why the DIY stores are faltering now. Also, speaking of the economy, the banking crisis is nowhere near over. There's a lull kind of in the bank failures. We had a string of banks failing in rapid succession, and then the Fed stepped in with their temporary measures where basically they would agree to buy the treasuries, the bonds that these banks were holding at their face value instead of what their fair market value was, because that was the impetus that caused some of these bank failures. Was they took depositors' money and they invested them in treasury bonds, and now all of a sudden with treasury rates 5% higher, interest rates 5% higher than they were when they bought the bonds, the value of those bonds plummeted to significantly less than their face value, which meant that they were insolvent. Right? They had less money than they had less money than they had liabilities, and therefore they were insolvent. So by the Fed allowing to not buying, but loaning, giving these banks loans at the face value of these treasuries, basically they're wallpapering over the problem, because eventually those bonds will come due and they will be worth less than, eventually those loans will come due and those bonds are still worth less than their face value. So either the Fed's going to have to purchase those bonds, or maybe cut rates to where those bonds will go back up in value, or we're going to continue to see more banks fail. And if you remember back in the 2008 financial crisis, it was like March of 2008 when Bear Stearns began to crumble. And then there was a lull and not really a whole lot happened until September. I think it was September 15th of 2008 when Lehman filed for bankruptcy. So what's that? April, May, June, July, August, September, 6 months between, a 6-month lull between bank failures. So it's only been a couple of weeks since we had those bank runs and those bank collapses. So if this is anything like the 2008 Great Financial Crisis, we could easily go into the fall before we see the next bank fail, and that does not mean that the crisis has been solved. So the lull in the storms, there's a lull in the storm while these banks survive off their temporary Fed measures, and that's to be expected, but it does not mean we have seen the end of that. The other huge news, and it's still going on out there in the Twitter sphere, was the Ledger recovery controversy. If you haven't somehow heard this, the Ledger, the manufacturer of the Ledger Nano S and the Nano X, introduced a new feature called Ledger Recovery, where basically you could lose your ledger, and it's a paid service, and if you pay them to do so, basically they have a service that extracts and encrypts your private key. It shards it into 3 different shards, and 3 different custodians basically will hold on to the bits and pieces. It takes 2 of the 3 to recombine your key. But the long and the short of it is, if you lose your key, you lose your ledger, and you have this service, they can recover your Bitcoin for you on a brand new Ledger device. And that had a lot of people freaking out, because previously to this, Ledger had been leading their customers to believe that it was impossible for them to extract your private key off a device. Obviously, this was a slap in the face announcement, a wake-up call that yes, they can extract your private key from your hardware wallet, and you were basically trusting them to not have firmware on your hardware wallet to do so. So the responses, in addition to panic, have ranged from "this is no big deal" to "this is a big deal" to "this is the end of the world." There are those that are saying that this was all just a fundamental misunderstanding about the nature of hardware wallets, that it's always possible to flash a firmware onto any hardware wallet that enables for the extraction of private keys, and that this is necessary because that's the only way a hardware wallet can sign a Bitcoin transaction. But if your hardware wallet is open source, and this is the key, then even if you don't know how to read the code, there are hundreds of Bitcoiners out there who do. So there's lots of eyes, looking at this code, and you can trust that at least you can put your trust in the community that there isn't any code on your device that can allow for the extraction, the exfiltration of your private keys. Ledger being closed source, nobody can look at the code. So this might have been available all along. There might be a situation where that firmware can be used by an attacker to extract your keys, and we just don't know because the operating system is closed source. So we just don't know. You have to put your trust in Ledger that they will be the only ones that do that. But more importantly than that, if you use the recover service, Ledger flat out admitted if they get subpoenaed by a government agency, they're going to turn your private keys and your Bitcoin over. So this is a horrible service. Do not use it. Maybe your Ledger is still safe to use. You don't know because it's not open source. I will be getting rid of my Ledgers and transferring my Bitcoin to my cold cards that I have because I don't trust them. And yeah, somebody could come along and put firmware on a cold card that would allow them to do the same, but they haven't. At least they haven't as far as the Bitcoin community believes, because their firmware it's not free and open source, but it's auditable. That's a kind of a controversy with cold card, but people can look at the source code and know that this ability is not on there. So if you have a Ledger, look into this, do your own research, decide if the risk is worth it to you. If you have a lot of Bitcoin on a Ledger, and I don't think this is a problem with the Ledger Nano S, this is the Ledger Nano X. Amongst the people that were discussing this, I think Jameson Lopp was on a panel at Bitcoin 2023 in Miami, and they discussed this. Then he later did a podcast with Andreas Antonopoulos where they went over this for about an hour. And one of the things he said was your Nano S's don't have enough memory to execute that version of firmware, so that's why it's only available on the Nano X and bigger. But that doesn't mean there isn't the possibility to execute similar firmware with the Nano S, and we just don't know because it's closed source. So if you have a lot of money on your Ledger and you're using it as cold storage, do some research into this and decide what your course of action should be. But the one thing that Andreas Antonopoulos did point out is do not do this in a rush. How people get victimized, how they either lose their own Bitcoin or they get suckered into a phishing attempt, is because they're panicking. Something like this comes up and they're like, oh no, and then they react. They react before they really thought it through, and that's a mistake. So take your time, do your research, figure out a solid plan if you decide to change. If you do decide to change, remember, use your basic prudent setup procedures where you set up your new hardware wallet, send like $1 to that hardware wallet and then blank it and then restore it from your private key to make sure that you are capable of doing so. And just take, basic common sense measures like that before you jump and move all your Bitcoin, because it would be a shame to move it and lose it if your Bitcoin really isn't at much of a risk as you might think, depending on your particular threat model. I will be moving my Bitcoin because I feel betrayed by Ledger. I took a gamble in trusting them with their closed source software because it was the most popular hardware wallet out there. It was kind of safety in numbers thing. Nobody had a problem with their devices. Yes, Ledger has had their problems where they've leaked customer data, but the devices have been secure, at least as far as we know. Nobody's ever had a Ledger hacked. The firmware has never leaked anyone's private keys that we know of, and I think there's 5 or 6 million Ledgers out there floating around. So it wasn't trust in Ledger, it was trust in numbers, the safety in numbers kind of thing, but that apparently was misplaced. Now, one of the things Andreas did say on that podcast was he's going to continue to use his Ledger, but that's only because he uses his Ledger not for cold storage, but for his day-to-day purchases. So he doesn't keep anything on any kind of hot wallet. He uses other devices for his deep cold storage, and then his small amounts that he uses for operating his business, his merchandise store, whatever, he keeps on a Ledger, which is still more secure than just on a phone or software wallet, or definitely more secure than a phone or software wallet. And it's an amount that's small enough that if he lost it, it wouldn't be the end of the world. So that's the kind of sort of thing to take into account. But even a small amount of Bitcoin today can be a tremendous life-changing amount of Bitcoin in the future if Bitcoin goes up to $1 million or $10 million a coin, for example. So you need to take that into account as well. But if it's just a day-to-day wallet like Andreas is using, then he's not going to get rid of his Ledger for that purpose. But definitely do some research on this, plebs, because this is a big deal. Maybe it's been a big deal all along and we just didn't know. Maybe we all fundamentally misunderstood the nature of hardware wallets, as Jameson Lopp pointed out. I believe the Canadian Bitcoin podcast yesterday or the day before discussed this as well. And basically they were pro-ledger, I think, was what the takeaway was. But it doesn't matter. As with everything in Bitcoin, do your own research and make sure you have a plan of action that you feel comfortable with. All right. So that's really all the news out there that's worth discussing. I'm sorry I didn't get to meet you guys at Bitcoin 2023. Obviously, there wasn't a lot of your favorite podcasts just kind of disappeared last week. There wasn't as much Twitter activity, I noticed, because everybody was enjoying their company of each other instead of tweeting. At least the 30,000 of us that were at Bitcoin 2023, or however many were there this year. I guess the attendance was dramatically less than the previous one. One more thing about Bitcoin 2023. There are a lot of people really mad at Bitcoin Magazine for entertaining the whole ordinals thing. They had Udi on stage dressed as a wizard. And there were some just other speakers there that many plebs, not even maxis, but just the average pleb, were furious that Bitcoin Magazine would have entertained at what's supposed to be a pure Bitcoin signal conference. I don't know. I wasn't there. Yeah, I think having Udi there was a disgusting choice, but still, for me, if I had gone, I think a lot of people I've spoken to didn't even attend most of these most of the keynote speeches. One of the people on one of the podcasts that I listened to mentioned that he only attended three speeches, 3 live events, and the rest of the time he just spent wandering around hanging out with people. And that's kind of the tactic I would have taken, because I think, again, the most important part of the conference is getting together, meeting, and networking. I wouldn't have wanted to miss Jack Mallers and Robert F. Kennedy Jr.'s speech for sure. Those would have been the two that I would have seen. But in general, I probably wouldn't have been disappointed in the conference, because it sounded like it was a really good time, even though there were some S-coiners there. Some S-coinery and Udi and that ordinal shenanigans. All right, back to why we're here, and that is because today is DCA Wednesday. If you don't know what DCA stands for, DCA is short for dollar cost averaging, which is an investment strategy where you invest your money in equal portions at regular intervals regardless of price. For example, this will be our 96th stack. We started stacking Bitcoin all the way back on Wednesday, July 28th, 2021, almost 2 years ago. So far we've stacked 95 times, and we've done that. So our regular interval is Wednesdays, and our equal portion is $20. And so far we've stacked 95 times for a total of $1,900 including $42.75 in fees. And that has earned us a stack of 6,587,076 sats, currently worth about $1,803. So a little bit underwater. So we're underwater by about $97, but almost 43 of that is fees. And the idea is to build the stack. Obviously, dollar cost averaging, sometimes you're up, sometimes you're down. The idea is in the long run, Bitcoin goes up and to the right, and so you want to avoid trying to time the markets, because, for example, had we YOLO'd in at that all-time high, or YOLO'd in even when we first did our first podcast, we would have purchased at $39,716, and we'd be dramatically more upside down than we are now. As I've mentioned in almost every other podcast, the reason I chose weekly is because for most people, they DCA any of their investments on payday, and most people get paid weekly. But again, do your own research. You do you. If you get paid bi-weekly, if you get paid by the job, you set up a strategy that fits in your financial plan. And the reason I chose $20 is because I wanted to show that anybody can amass an appreciable stack of sats, even if all you can come up with is $20. For a lot of people, that's pennies, and for other people, that makes a difference in whether they get through the week or not. So I wanted to choose an amount that was relatively small, for the average person. That's, almost one fast food meal. I went through the drive-through at a place here to get a place where I'm at right now to get a burger and fries and a drink just the other day while I was out and about. And it was more than $15 just for me, just for one combo meal. So $20 is not a whole lot for the average American. I understand that for a lot of people, however, $20, is hard to come up with. So you do you. Pick an amount that you can feel comfortable, stacking away for the long term. That's not going to make the difference between being able to buy groceries or pay your rent, but also an amount that's enough that it will appreciate to an investment level that would be beneficial to you, because if you're making $250,000 a year, an extra $1,000 might not mean that much to you. So again, do your own research, you do you. But the key is that you are consistent, that you're not trying to time the market, because as has been pointed out by numerous Bitcoin OGs, the majority of Bitcoin's price moves occur in about 10 days out of the year. And, even in bull runs, even when we were setting our new all-time high, if you watch the chart going up and to the right, there were drops. It wasn't a straight line. It's a jagged line. So they say timing the markets beats timing the markets every time it's tried. And so far, that's worked out for us. And we're going to continue today by purchasing another $20 of the Bitcoin using the handy-dandy Cash App. Cash App is not a sponsor of the show, but I've been using them this entire podcast for all 96 of these stacks so far, or 95 of these stacks going on the 96th stack, just because I think they're one of the easiest apps to use. But, they're not available everywhere. The fees are a little bit more than other exchanges or apps out there. So do some research on that as well. For example, Strike is now worldwide. That's another announcement that Jack Mallers made. And they don't charge any fees, but there are other ways they charge you. Like they charge 2% to transfer cash to the app to make your purchase. So boom, that's 2% right there you're paying in fees. And they charge a spread, which before they started charging that 2% fee, that spread was working out to more than 2%. For example, if Bitcoin was 25,000, you would pay like 25,300 or whatever. So a lot of exchanges do that. They say they don't charge you any fees, but by charging you slightly higher than the market rate of Bitcoin, that works. That's a fee in my book. So do your own research, pick an app that suits your needs, and we're going to use Cash App. So I've got the handy dandy Cash App open. I've already added $20 because I had to send a family member $30 for a haircut a little while ago. So I've already got the money on the app. Press buy, enter $20, press confirm, and boom, just like that, we purchased another 74,214 sats at a price of $26,342.29. So down about $50 from when I first started, from when I first started the podcast, but pretty much right where we were when the podcast first started. Sometimes I've started talking and Bitcoin explodes in price, and other times during the half an hour, 45 minutes I've been talking, the price goes down and we get a better deal. Today worked out to about the same. But one of the coolest things is that 74,000 sats, well, that's 2,000 sats more than we got last week, 4,000 sats more than we got 2 weeks ago, and 7,000 sats more than we got a month ago. So that's the cool part about Bitcoin being on sale. If you're a stacker, watching the price go down should make you happy because we got more sats. And that is going to raise our total stack to 6,661,290 sats. Currently, that's worth $1,754.73. So either my math was off on the previous purchase, or I guess I'll have to reevaluate that. Sometimes I get little flaws in my spreadsheet, because today's purchase did knock our average cost basis down by another $21.11. Previously, our average purchase price, our average cost basis was $28,844.36. Yes, that's upside down a little bit, underwater a little bit. Currently, our average cost basis is now $28,823.25. Still underwater, but better than it was. And if Bitcoin stays on sale, we're going to keep knocking that average cost basis down. If Bitcoin doesn't go on sale, when Bitcoin reclaims its $69,000 all-time high, having an average purchase price of $28,800 will be not too shabby. More importantly, if Bitcoin goes to the moon, if that moon for you is, say, $1 million, that stack of Bitcoin will be worth $66,612.90. So that would be a heck of a return. Even if Bitcoin only eclipses 100,000 this bull run, that stack's still going to be worth $6,661.29, which is certainly a lot more than the $1,900 that we've invested. So that's really cool. But plebs, the only thing that matters is that when Bitcoin does go to the moon one day, well before hyper-Bitcoinization, but at hyper-Bitcoinization, that you're not kicking yourself for not stacking more. Everybody has that first touch with Bitcoin where they hear about it, they know a little bit about it, but they don't get any, and they kick themselves for not getting in when it was cheaper. That will be you. That is your future you at this moment. If you aren't in right now, or if you're not growing that stack right now, do not be in the position where Bitcoin is at $1 million or $10 million, and then the fiat currency may not even exist anymore. Your choice might be a U.S. central bank digital currency that they can manipulate and control, like the Chinese do, or Bitcoin. And if you don't have that stack, you'll be kicking yourself. So again, don't invest any money that you can't afford to lose. That's the other reason we're only putting $20 a week into Bitcoin. A lot of people that are financial advisors, and I am not, this is not financial advice, say, put 1% of your net worth into Bitcoin, because you lost more than 1% in stocks today. And Bitcoin would have to go to zero for you to do that. But the asymmetric return on Bitcoin, if Bitcoin goes to 1 million, all of a sudden that 1% could be the majority of your investment portfolio for very little risk of only losing 1%, which, like I said, with less than you lost in the stock market today if you were in an index fund. So I'm yammering on a little bit here. Basically, if we had YOLO'd in on July 28th at $39,716, we'd have purchased a stack of 4,834,000 sats, and that is 1,827,000 sats fewer than we currently have. So I think we've clearly shown that by not trying to time the market, we've definitely done a heck of a lot better. And plebs, stackers, we're going to do just that next Wednesday and every Wednesday until Bitcoin either goes to the moon, goes to zero, or you get bored and stop listening, or I go off the air and barricade myself in my citadel, off grid somewhere, because my stack will be generational wealth, or at least enough to get by and avoid using central bank digital currencies. Real quick, I want to reach out to you and ask you to give us a shout out and a follow on Twitter. On Twitter, we are at BTC Bulletin Pod. Let us know what you think. Send us a DM. Engage with us on Twitter. The more Twitter followers we have, the more likely other people are to find out about this podcast, the more likely it is that we're going to be able to help orange pill other people. So please give us a follow on Twitter. If you don't have Twitter, you don't like to use Twitter, we are on Nostr. If you're not on any of those, you can also contact us by email. My email address is bitcoinbulletin@protonmail.com. There are other ways you can help support the podcast or give us a shout out, such as through the links in the show notes for via Spotify or whichever podcasting app you're listening to. Of course, your podcasting 2.0 apps, you can send a message as a boost, which means you can also help support the show, but also let us know what you think. And there are some other ways you can help support the podcast, such as the referral links. If you haven't begun stacking, if you want to use Strike or you want to use Cash App, for example, or you want to use the Fold app, there are referral links in the show notes where you'll get something for clicking on those links. Currently, I think it's $5 for Cash App, $10 for Strike, and I think Fold right now is up to 50,000. It says 20,000 sats in the show notes, but I just got a text from Fold saying that referrals are now 50,000 sats if they sign up, and I think that you have to spend $20 or something. But it's every one of those apps. If you're not using them, you'll get something for using a referral code that you wouldn't if you don't. Again, none of those are sponsors of the shows. Any user of any of those apps, you get your own referral code once you sign up that you can pass along to your friends and family. But if you don't and you use our referral codes, you'll help support the podcast. All right. Again, please follow us on Twitter. We're at BTC Bulletin Pod on Twitter, or send us a shout out via email at bitcoinbulletin@protonmail.com. But other than that, we will see you next Wednesday and every Wednesday while we grow that stack together. Until that time, keep on stacking those sats, you sexy sat stackers.